of the big sectors to watch out is capital goods, especially because capital goods feeds into many other big core sectors of the Indian economy. We have Renu Baid who's joining us from IIFL to talk more about it. Renu, I'd like to, there are the 2 points on which we invited you today. One, yesterday we were speaking with Sanjeev Sanyal of Prime Minister's Economic Advisory Committee, and the one of the takeaway was that, and you must have seen RBI Governor's interview on ET Now last week, where he almost said that near 8% growth for this year and then 7% for next year. So one is, Sanjeev Sanyal yesterday alluded that now we are moving to high growth and longevity of growth kind of a period. So I'll play parts of his conversation and then I'll come to you to understand what could this mean, high growth and longevity of growth for capital goods space.
The way to look at quality of growth is to look at the stability indicators. So are you generating high growth without generating inflation, without causing stress to the banking system, causing stress to your external accounts, and so on and so forth. And as far as quality of growth is concerned, in all of those parameters, inflation is running at about 5%, which is within the band. We are accumulating foreign exchange reserves. Our current account on the external front is well behaved. Our banking system is well capitalized and profitable. So none of those sectors are showing stress. So in terms of quality of growth, that suggests that we are generating high growth without causing macroeconomic stresses.
All right. So this is the premise I'm talking to you, Renu, this morning with, that it appears that policymakers, regulators, the data speaks for itself, last two GDP numbers. So if we are in a prolonged period of high growth in a band, how does capital goods space actually pan in this kind of period? Because we have not seen a strong capital goods cycle for a very long time. It appears now it's starting off. When you talk to many of the companies under your coverage.
Yeah, hi, afternoon. So if you look at the capex cycle, there are two legs of it. One, how is the private sector investment panning? And second, how is the government sector investment panning? So if you look at the private sector, most of the light manufacturing sectors have done well in terms of investments. And now some of the core and the heavy sector investments are also starting to look up, specifically in the steel and the minerals and metal segment. So to that extent, the private corporate capex is clearly looking up. When we compare it to the previous cycle, what the missing link was largely coming in from the power segment, which was definitely in terms of investment size heavy. At the same time, the long lead cycles made the investments far more lumpier and large in terms of the mix of capex. But X of power, if we see even the current environment, clearly the capex cycle has been on an up move for the last 2 years. To this, again, it's a combination. If you look at the government side, while some of the sectors like road, etc., have been soft, but investments in railways has been very strong, and infrastructure like water has been strong. So I think the biggest missing link when you look at aggregate data was the power sector, because in terms of overall number, this sector used to contribute nearly over a third in terms of the overall capex number if you look at the long-term trends. And this sector was completely missing over the last decade or so. And now, given the kind of power crisis that we are into, government has been very tight on its feet in terms of bringing back thermal power and resolving various issues which were linked to renewables and evacuation of power. So I think incrementally, as we move in the next 12-18 months, we will see towards fiscal 25 second half and fiscal 26, aggregate numbers will tend to improve, also driven by the investment and the actual capex coming in from the power sector. Within the power, we think while generation has multiple legs here, T&D from a capital good perspective will look far more promising because the supply chain, the vendors are far more prepared today compared to thermal. Thermal, over the last decade, the entire supply chain has been completely distorted, and it will take a couple of years for the industry participants to get its feet back in order.
Renu, I want to talk about specifics now. What are your 3 top ideas to play this? What you just explained. Also, what are your thoughts on valuations? Which sometimes, valuations which appear slightly, kind of stretched, but they have very good visibility on growth. So, what are your 3 ideas in this light?
So overall, if you look at the cap goods sector, our top three ideas, our preferred picks in the current level, at looking at valuation, etc., everything has clearly been Cummins, Bharat Electronics, followed by Larsen. Larsen we like, but we think both in terms of valuations and the incremental drivers in terms of order flows execution will take a bit of backseat during the election year. But the long-term growth prospects looks good. On the valuation front, if you see, I think the overall sector has re-rated very sharply, and it's been now almost 18 to 20 months that re-rating has been intact. But given the relative risk reward and the opportunities for earnings upside or earnings upgrade that we see, the visibility, I think clearly Cummins provide still incremental good visibility if demand remains intact for short cycle products. And the levers here are all diverse, right? From manufacturing, construction, infra, to your power sector or the core sectors which require electricity, where there will be very clearly shortages visible in the next 2 years, along with data centers and other markets. And exports will also be a very clearly visible driver in the next 2 years, especially for energy sector related demand coming in from the US and the European markets. So we clearly like Cummins valuations compared to the rest of the peers. Still look in the comfortable zone, while they themselves have re-rated by almost 30% in the last year or so, but still better off. On the second hand, on the other hand, if you look at names like Bharat Electronics, again, a pure play defense with high quality visibility on order flows, proven track record in terms of project management and execution of large system orders. And more importantly, the balance sheet quality is very strong. So the kind of certainty of earnings which is there in Bharat Electronics is far superior at this point in time compared to some of the other defense PSUs. And in the backdrop of what is happening around, again, the India-China border, I think defense will continue to remain one of the key structural themes in this space. Unfortunately, if you look at the power value chain, there are no really clear proxies, high quality growth proxies with strong fundamentals at this point in time on the generation side. If you look at the cap goods, utilities, yes, one can look at generation and transmission utilities like NTPC,
Right.
Power Grid and others.
All right, Renu. Renu, I'm sorry, I'll have to butt in over here. We are completely running out of time, but really appreciate your inputs this afternoon, and thank you very much for accommodating our interaction request. With that,